Good morning, grade 12s. The topic for today's lesson is the management of tangible assets. This is the next thing that we are supposed to cover in grade 12, but you will see a lot of what we are going to do in today's lesson is basically revision from grade 10 and grade 11, but obviously you still need this for grade 12. Okay, so if we look at tangible assets, firstly, the business purchases their fixed assets with the aim of using them, not for selling them. Okay, when they purchase a fixed asset, the purpose of that asset is to be used in the business in order to generate a profit for the business. They do not generally buy the asset to sell it. Okay, that is not the purpose of buying a fixed asset. Okay, they are required for investment purposes, as I mentioned just now, to assist the business to generate a profit. Obviously, they need their fixed assets to process raw materials, for example. They need machinery to process their raw materials. They need vehicles to deliver the final product to their consumers. So it's there to help them to generate a profit. Okay, but the tangible assets that they do buy, it must be managed properly. Because of the large capital outlay, any tangible assets that they buy is an expensive item that they have to pay for. So obviously, because it costs them a lot of money, those assets has to be managed properly and it has to be used properly in the business. Okay, so tangible assets are used over a longer period of time, unlike your current assets. Okay, remember, any asset that we are going to be using for longer than 12 months is going to be classified as a tangible or a fixed asset. And any asset that is liquid and can be turned back into cash within a period of 12 months, that will be classified as a current asset. All right, so all of our tangible assets that we are going to look at, the focus of this lesson is the tangible assets, not the current assets. Okay, current assets, we basically finished now when we did the inventory. Those was current assets. But your tangible assets, we are going to use them over a longer period of time. Okay, depending on obviously the lifespan of the asset. Okay, so in grade 10, when you did accounting in grade 10, you dealt with the acquisition and the depreciation of the tangible assets. And then in grade 11, you were also taught the disposal of assets. Okay, so in this lesson, over the next 2 or 3 lessons, what are we going to cover? Okay, we're first going to look at the age of assets, the depreciation of assets. We are just going to do a quick revision of this. The replacement value, the lifespan of assets, the acquisition and disposal of assets, also just a quick revision. The GAAP principles that relate to the fixed assets, the ethical issues that relate to the fixed assets, and then the internal audit and control measures relating to the fixed assets. Okay, so if we look at the tangible assets now, okay, as I mentioned before, your tangible assets that is bought by the business, they are not bought with the intention of reselling them, but they are bought with the intention of using them to assist in the daily operations of the business in order for the business to function and generate ultimately a profit. Examples of your fixed assets that we are going to be working with includes your land and buildings, your vehicles, and then equipment. Okay, this is basically the 3 that we've been dealing with since grade 10. The value of our tangible assets, now we know now, like the vehicles and the equipment, it depreciates over time because of wear and tear. Because we are using them on a daily basis, they are not going to keep their value over a long period of time. Okay, so when we purchase things like vehicles and equipment, we have to make provision for the fact that the value of these assets can decrease over time as a result of wear and tear. However, the value of land and buildings tends to appreciate over time if the property is well maintained. But in grade 12, we are not going to cover this in your syllabus. Okay, when you go to university, you're going to deal with the appreciation there. We are just always going to keep the value of our land and buildings the same, okay, because we do not make provision for depreciation on that because it actually appreciates over time. Concepts that is unique to the tangible assets, most of these you will be familiar with. Depreciation, we said, is a reduction in the value of an asset over time due to wear and tear. Okay, the fact that the value of it decreases over time because we are using it. Then your accumulated depreciation is the total amount of depreciation that has been deducted from the fixed asset since its acquisition. Obviously, every single year we make provision for depreciation for that year, and the accumulated depreciation is basically the sum total of the depreciation that have been calculated every single year. We're just going to add them together. So over the lifespan of the asset, every single year your accumulated depreciation will increase because we make a provision for additional depreciation for that year. Okay, when we refer to the carrying value or the book value, this is basically the original cost price minus all the depreciation that has accumulated over the period in which the asset has been in the business. All right, so basically if you want to calculate the carrying value in year 5, you're going to take the original cost price of the asset and you're going to subtract all the depreciation that has accumulated on that asset for the last 5 years. Okay, when we talk about the age of the assets, it's very important that businesses monitor their assets to identify assets that needs to be replaced. Obviously, things like vehicles, when they start to become old, they start to become problematic. Okay, the maintenance cost is going to increase. There's going to be a lot of breakages. That is going to mean that we are going to incur some extra expenses. So assets that are old due to wear and tear should be replaced with newer assets that can be more efficient. All right, the maintenance costs are much less on a new asset compared to an old asset. So businesses must keep an eye on their asset registers to see how old all of their assets are so that they can dispose of those assets before they start breaking down and not working and becoming obsolete or whatever. Okay, the replacement rate refers to how often the business wishes to replace their fixed assets. Okay, there are certain allowances made by SARS. Okay, SARS have certain guidelines with regard to how often certain assets should be replaced. Okay, so businesses will obviously refer to those guidelines when they decide how often to replace their assets. The replacement value, okay, so when we decide on the replacement value of an asset, obviously we need to see if it's worth replacing an old asset and what it's going to cost. Okay, replacement value refers to what it is going to cost us to buy a new asset in order to replace the one that we have now disposed or the one that is obsolete or broken down completely. So how much money do we have to spend to replace that asset? And then lastly, the lifespan. When we refer to the lifespan of an asset, we are referring to the estimated length of time that we think an asset can reasonably be used inside of a business. All right, so if we say the lifespan of a vehicle is 5 years, we are basically saying that we buy a vehicle and this vehicle will serve the business. We're going to use this in the business to generate an income for this business for a period of 5 years. Okay, the period of 5 years is over. We will then dispose of this asset because it serves no purpose for the business anymore. Okay, now when we look at the acquisition of assets, there are certain things that we need to consider when we decide whether we are going to buy new assets. Okay, things that we have to look at, factors that we have to look at before we make the decision to purchase a new asset. The first thing is we have to look at our existing assets. Okay, the assets that we actually have in the business, have they become so old and out of date that they serve no purpose anymore? All right, if they are too old, obviously, as I mentioned, there will be more breakages. Maintenance costs will increase quite significantly. So we would like to replace them with new technology that is not going to have all of those repairs required, which increases our costs. Or if your existing asset is out of date, okay, there's new technology available, and you would like to replace your old technology with new technology to make your production more productive, for example. All right, so that is the first thing that you're going to look at. Then you're going to look at the running costs of your current assets. As I said, as soon as your assets start becoming older, the maintenance cost increases. They start breaking down more often. They need to be fixed all the time. There's downtime in the factory because the machine is broken again. So you need to see what is the running cost of your current assets. How much money are you spending on these current assets just to keep them going? All right, and then as I mentioned, businesses might want to keep up to date with new technology if new technology is available, the business would like to implement the new technology in their factories, because obviously it will increase their productivity. New technology obviously is more innovative, and it can improve the quality of your product. It can speed up your production process, and obviously that leads to higher profits. Okay, we look at the asset register. The asset register is basically a list of assets that belongs to the business, because this is part of the management of your tangible assets. At any given point in time, you need to know exactly what assets you have that belongs to the business, what their market values are, okay, when they were purchased, how much depreciation has been written off on them. There's a whole long list of information that goes onto this asset register that is going to help us to manage our tangible assets properly. Okay, so the purpose of keeping an asset register is to keep track of the book value of our assets. Okay, so you'll see on the asset register, we're going to enter the cost price. Okay, so how much we paid for it originally. Then we're going to keep record of every single year when we make provision for depreciation, so that we can calculate at any given point in time what the book value, the carrying value, the market value is of this asset, so that obviously for the reporting purposes. All right, the book value of your asset is what is recorded in your financial statements, and that is obviously going to affect the amount of taxes that you're going to pay. All right, remember, depreciation is a tax allowance. Okay, the fact that we are writing off depreciation and treating it as if it was an expense, even though it's not, it helps us to decrease our tax burden. So it's very important that we keep record of the depreciation, so that we can prove what we have done in terms of depreciation if SARS decides to audit us, or whatever the case may be. Okay, so the business must keep every single transaction that relates to an asset has to be captured in that fixed asset register. As I said, every single year when we make provision for depreciation, the depreciation has to be noted in the fixed asset register, and it has to be updated on a regular basis. Each asset that is owned by the business must have its own detailed entry page in the register. And I'm going to show you just now what it looks like. Okay, so every asset will have its own little asset register where we can get all the information relating to that specific asset. So what information are we going to record on the asset register? First thing is the date of purchase. Okay, exactly when this asset was purchased. The cost price, okay, what we paid for the asset when we purchased it. The details of the seller, who did we buy it from. The type and the model, as well as the serial number. And then the receipt or the invoice number of our purchase. Okay, obviously, because from the receipt or the invoice, that serves as our source document to go into our journals. Then also the rate of depreciation. Okay, so obviously we have to decide how are we going to make provision for depreciation, the percentage that we're going to depreciate by, as well as the method of depreciation that we are going to use. Okay, then also the book value. Okay, obviously we need to know at any given point in time what the market value of those assets are. The life expectancy of the asset, how long do we expect to use it in the business before it is disposed of or before it becomes obsolete. I already mentioned the method of depreciation. We'll go with the rate of depreciation. Then we will make notifications every single year when we make provision for depreciation. It will be written down on that asset register, the amount of depreciation that we've made provision for will be indicated on that asset register, as well as then the accumulated depreciation will be updated at every year. Once we've made provision for more depreciation, we will add that to the accumulated depreciation of the previous year to update also what the accumulated depreciation is at the end of this financial year. Okay, and this is what your asset register looks like. Okay, more or less, this is just an example. You'll see that we're going to put the general ledger account. Okay, so this is obviously a vehicle. So it's going to go into B6 because that is the folio number for their vehicles in their general ledger. The asset is a Nissan delivery van. Okay, 2 liter. That's the make, whatever. Make and the model. From who did we buy that? This was bought from Nissan Monument. And then the date that we've purchased it was the 1st of March 2021. The cost price, what we've paid for it was 180,000. And then here's all the details for the depreciation. Okay, we are going to make provision for 20% of depreciation at cost price. Okay, so that's the method that we're going to use to calculate the depreciation. And then every single year, when we make provision for depreciation, details are going to be entered here. Okay, the date for the end of the financial year is going to be entered there. The depreciation, the calculation of the depreciation, okay, how much depreciation are we going to make provision for during this year? Okay, how much is the accumulated depreciation? Obviously, for the first year, your annual depreciation and your accumulated depreciation would be exactly the same. And then at the end of this financial year, once we've made provision for the depreciation for the year, what is the book value or the carrying value at this stage? All right. Next year, we're going to do the same thing at the next financial year end. Again, we're going to fill in the date. We're going to calculate the depreciation for the following year. And then obviously we're going to take the accumulated depreciation of last year plus the new depreciation that we've made provision for this year. And that is going to give me my new accumulated depreciation. And then your carrying value, you're going to take your cost price that is there on the asset register minus your accumulated depreciation to get the carrying value at the end of your second year. And so you'll carry on every single year after that until you decide to dispose of this asset. So if we just look at the two different depreciation methods, okay, the fixed method takes place over the useful life of an asset as a fixed rate. So basically we are going to say that we make provision for 20% depreciation over 5 years. This will be your cost price method. Okay, we take 20% on the cost price of the asset. So every single year it's going to be 20% on the cost price. So your depreciation every year is basically going to stay the same. It's a constant rate. Then your diminishing balance method is where we're going to write off depreciation on the carrying value at a fixed percentage. Also, your percentage is going to stay the same, but it's going to take you a bit longer to write off this asset over a longer period of time because you are using the diminishing balance method. So your asset tends to last longer, all right, because your carrying value will decrease every single year. Okay, the standard formula for if we are calculating your depreciation, you're going to take the amount, whether the amount here, obviously it depends on the method of depreciation, but this amount here, it can be the cost price. Okay, so this can be either the cost price or it can be the carrying value, depending obviously on the method of depreciation that you're going to use. The rate is obviously the percentage of depreciation that you have decided on. And then the period of time, obviously, if you are calculating depreciation for a whole entire year, it'll be 12 over 12, so it'll be 1 year. Otherwise, if you are just calculating depreciation for a certain amount of months before you dispose of the asset or you purchased it in the middle of the year, okay, you'll calculate here the amount of months that you had this asset for. And that is going to give you the amount for depreciation. If we look at the disposal of tangible assets, okay, again, fixed assets are not generally purchased for the purpose of resale in the normal course of running a business, but if the owner feels that he no longer needs the asset serves no purpose in the business anymore, he can decide to dispose of it. Okay? If we can't use it in the business anymore, it's pointless to keep it, then we rather sell it and we get some money into the business. So if an asset is sold, the business will have to remove the asset from the financial records of the business. And I'm going to show you with the general ledger accounts how we're going to do that. Okay, it is revision, so you've done this before. The reasons for disposal, why would we find it necessary to dispose of an asset? First of all, if your existing asset is just too old and it has outlived its useful life, it's just not useful to us anymore. All right, it's too old. It's obsolete, it serves no purpose in the business anymore, we can no longer use it. Then vehicles, if you think of delivery vehicles, it might have been involved in accidents. Okay, so it could be that it is damaged so badly that we cannot use it in the business anymore. Okay, so then we're going to write it off. Damaged assets that cannot be used by the business anymore, okay, for whatever reason. Okay, if they're broken down to such a point that they can't be fixed anymore, or it's just too expensive to fix them, then it might be better to buy a new one to replace it. So then the old asset, we are going to try and dispose of that to get some money into the business. And then, as I said, the asset may be obsolete, okay, might be outdated, new technology might be available, and then we would like to stay up to date with those technologies, and then we're going to dispose of the older assets so that we can have money or some money to put down a deposit on a new asset. It's very important for businesses to stay up to date with the latest technology if they want to remain competitive in the market. Okay, now there's different ways that we can use to dispose of our tangible assets. Okay, the straightforward way is just we sell it for cash, all right? But there's lots of other alternatives that they can gooi into a question paper to try and confuse you. All right, so the first one, the obvious one, is if we sell an asset for cash, obviously the account that is going to be affected is going to be bank. Okay, remember the double entry principle. The first account that will be affected always will be your asset disposal. All right, so the one account is asset disposal, but what is your other account? All right, so if we are selling it for cash, bank is my other account. If I sell it on credit, my contra account will be debtors control. If I donate the asset, my contra account is going to be donations. If the owner decides to take the asset for his personal use, that is going to be captured as drawings. If the asset is traded in, so we trade in the old one in order to get a new one, then your contra account is going to be creditors control. If the asset is scrapped, okay, that means that we are writing it off. We are going to receive no payment for it. Okay, then there's nothing. And then if an asset is written off because of damages, okay, as soon as you see damages, then you hope that there was insurance. Okay, so then we're going to work with your insurance claim that was approved or accrued income. In the case of where we're going to say, right, the vehicle, it has been damaged, the insurance has agreed to pay out, but they haven't given us the money yet. Okay, then it is going to be accrued income, income that we still have to receive. Okay, so when we look at the disposal of tangible assets, there's three different situations that we can work with. Okay, so when is it possible for us to dispose of your assets? Okay, we can do it at the beginning of the financial year. It can happen during the course of the financial year, and it can also happen at the end of our financial year. Obviously, the way that we're going to do this disposable, way that we're going to deal with depreciation and accumulated depreciation will depend on when we are disposing of the asset. Okay, beginning of the year is easy, end of the year is easy. The tricky one is if it happens during the year. Okay, so when we dispose of the assets, we can dispose at carrying value. So in other words, whatever the market value of the SA is, of the asset is, that is what we are going to be receiving for it. We don't make a profit, we don't make a loss. And just remember, your carrying value will be the cost price, the price that we paid originally for the asset, minus the accumulated depreciation up to the point of sale. Then if we are lucky, we can also sell an asset and make a profit. So if the price that we receive, if the money that we receive for the asset when we sell it is higher than the carrying value, we will realize a profit. And when the price that we receive for the asset when we dispose of it is less than carrying value, then we are selling the asset at a loss. Okay, obviously, we don't want that. We would rather have a profit. Okay, now very important if we look at the format of our T accounts, of our general ledger accounts. Now, generally speaking, in grade 12, they don't ask you the ledger accounts. They tend to ask you note 3. Okay, with your balance sheet, they ask you note 3. But we have done a couple, I think 1 or 2 examples during this year, exercises during this year, where you need to complete the ledger accounts in order for you to complete the note 3. So it is important still that you understand how the ledger accounts work, so that if you need to calculate missing amounts, you can draw up your little T accounts and you can calculate those missing amounts. So it's still very, very important. Okay, so if you look at the asset disposal account, on the debit side, you are going to have obviously the equipment or the vehicles, and this will be the cost price. Okay, the cost price of the equipment or the vehicles that we are selling. Then on the credit side, we will have the accumulated depreciation up to and including all depreciation up to and including the day of sale. All right, so all the accumulated depreciation that it has accumulated up to the actual date that we are going to sell it. And then also on the credit side, it now depends. Okay, how did we sell the asset? If we sold the asset for cash, then we're going to put bank. If we sold it on credit, we're going to put debtors control. If we've traded it in, we're going to put creditors control. If we've donated it, it's going to be recorded as a donation. And then if the owner took it, it's going to be recorded as drawings. Okay, so this will depend on the transaction that they give you. And then we need to balance. Okay, we're either going to sell, obviously sometimes we sell at carrying value, then there won't be a loss or a profit. Okay, then it will balance automatically. Okay, but you have to balance your debit and your credit side. So if your credit side is smaller than your debit side, then obviously we are going to realize a loss. All right, so if the balancing item is on the credit side, then we made basically a loss on the sale of the asset. And if your credit side is bigger and the shortfall, the missing amount is on the debit side, then it was basically a profit. Okay, so if there's a profit, if we make a profit on the sale of the asset, it will be recorded on the debit side. If we look at the asset account itself, okay, so whether it's equipment, whether it is vehicles, whichever asset we disposed of, on the debit side, at the beginning of the financial year, we will put the balance brought down. And very important here, we record everything in the asset account is at cost. You'll see everywhere I say cost. Okay, so balance brought down at the beginning of the year at cost. If we purchased more assets during the course of the year, that would be captured on the debit side. So if we purchased more assets for cash, we will use the bank as a contra account. If we bought on credit, it is going to be creditors control. But whatever the cost price is what we are going to enter there. All right. When we do the asset disposal, okay, if we decide now some of the assets that we have purchased, we are going to dispose of now. Again, the asset disposal at cost. So the cost price of the asset that we are selling will go on the credit side, and then we're going to balance. Okay, so we need to work out what is going to be the balance at the end of this year, beginning of the next financial year, and that is our balancing item normally. All right, and whatever we balance, the balance we carry down there is obviously the opening balance at the beginning of the next financial year. Okay, now sometimes they will give you, okay, when we do the adjustments in the financial statements, they're going to give you, for example, the balance that was brought down at the beginning of the year. They're going to tell you what the assets was disposed of, and they'll tell you what the balance is at the end of the year. And then you have to calculate, for example, the additions. Okay, so how many extra assets was purchased for the cash flow statement, for example. All right, so then this will be a missing amount. That's why these general ledger accounts is still important. Okay, the format of your note 3, you should be familiar with this. We've worked with this already during this year in the first term when we did the financial statements. Okay, remember we always start with a carrying value at the beginning of the year, which consists of the cost price, okay, at the beginning of the year. And then just remember, for land and buildings, there won't ever be depreciation. So accumulated depreciation, depreciation, and accumulated depreciation at the end of the year, it's always going to be nothing because we don't make provision for depreciation on land and buildings. All right, but for vehicles or equipment, we're going to take the cost price and we minus the accumulated depreciation in order to get the carrying value at the beginning of the year. During the year, there could have been movements, okay, for both land and buildings or the vehicles and equipment. If we've purchased more assets, okay, that we are going to add in there, okay, and this will be at cost. This is important. Okay, this we will always capture at cost price. And then the disposals, if we disposed of assets, whether it's land and buildings, whether it's vehicles or equipment, that has to be subtracted, okay, because we sold them. But remember, this will be captured at carrying value. All right, obviously for land and buildings, cost and carrying value is exactly the same, okay? But disposals always happens at carrying value. And then for your vehicles or equipment, we have to make provision for depreciation for the financial year that has now passed, okay? Then in order for us to get to the cost price at the end of the year, we are going to start with the cost price at the beginning of the year. Okay, this is where we start. We're going to start with the cost price at the beginning of the year. We're going to add any additions. Okay, so anything that we have purchased, we add that. And then we have to minus the disposals, but we have to minus the disposals at cost price. We can't minus at carrying value. we minus the cost price of the assets that we have disposed of. And that is going to give me the cost price at the end of the year. Okay, in the same way with the accumulated depreciation, we're going to start with the accumulated depreciation at the beginning of the year. We need to add all the new depreciation that we've made provision for during this year, but we have to minus the accumulated depreciation of the assets that we have sold because we don't have them anymore. And that is going to give me the accumulated depreciation at the end of the year. And then obviously your cost price minus your accumulated depreciation is going to give me the carrying value at the end of the financial year. Okay, and then this amount, the carrying value at the end of the financial year, this is the amount that we're going to record in our financial statements, okay, because it reduces the balance of your assets. Okay, the carrying value is always less than the cost price because your accumulated depreciation has been minused, all right? But remember your prudence concept, we have to be conservative. Okay, when we estimate the value of our assets, we have to be conservative, we have to be realistic. We can't record in our books that our assets is still worth what they were worth 20,000 years ago. So that's why we make provision for depreciation. It's the carrying value that is going to be reflected on our financial statements because it gives a more accurate reflection of what our assets is actually really worth. All right, and then as I mentioned, your balances here at the end of the year. Okay, both your cost price and your accumulated depreciation at the end of the year, it will exclude any assets that was disposed of because we don't have them anymore. We can't keep them in our books. When we dispose of them, we need to remove them from our financial statements. So they can't still appear here. We have to remove them when we go to the balances at the end of the year. Okay, if we work through an example very quickly, okay, if we just look at assets bought and sold during the year, very straightforward example. The balance, okay, the financial year of BBB traders that ends on the 28th of February. Remember, it is always very important that we take note of the financial year end when we work with depreciation because we need to always see when is your asset bought, when is the asset disposed of. Okay, so how many months do we have to make provision for depreciation? Okay. So the balances in the books at the beginning of the financial year for vehicles, it was 312,000 and accumulated depreciation on vehicles was 104,000. Okay, then they say on the 31st of August 2020, BBB traders sold an old vehicle to Z traders for 47,200 Rand on credit. The vehicle originally cost 76,000 Rand and the total amount of depreciation at the beginning of the year amounted to 34,200. Now, all of this information is important. Okay, the date is important. Okay, when did we dispose of this asset? On the 31st of August 2020. It is after the financial year started. Okay, the financial year started on the 1st of March and we sold this vehicle on the 31st of August. Okay, we sold it, we got the amount that we received was 47,200. Okay, but we sold it on credit. Okay, so credit, this is important as well. Okay, the vehicle originally cost 76,000 Rand. That would be its cost price. Okay, that there is its cost price. And then the total amount of depreciation at the beginning of the year amounted to this much. We didn't sell it at the beginning of the year. We sold it in the middle of the year. Okay, so this is also important. Then on the 1st of December 2020, also a new delivery vehicle was bought for cash. That was 200,000 and the funds was transferred electronically to the motor dealer. Okay, now again, what is important here is the cost price. Okay, this obviously 200,000 Rand is what we paid for it. We paid cash. Okay, so that is going to be important. Okay, and then obviously the funds was transferred electronically. Then they give us the information on the depreciation. How are we going to calculate the depreciation? Depreciation is calculated at 20% per year on the diminishing balance method. Okay, so we are going to make provision for depreciation on the carrying value. That is important. Okay, so the first thing that we need to do now, because now we have the balance at the beginning of the year, we know that there was an asset disposal halfway through the year, and somewhere during the course of the year, we also purchased additional assets. Okay, so an easy way of doing this is to quickly see what is your total assets, what is the asset that you have sold, and then of the assets that you had in the beginning of the year, how much is remaining in the business. Now, this was the balances that they gave us at the beginning of the year. Okay, they told us the balance at the beginning of the year for vehicles was 312,000, and the accumulated depreciation at the beginning of the year was 104,000. So to calculate the carrying value at the beginning of the year, you take the 312,000 minus the 104,000, that is going to give us the 208,000. But now on the 31st of August 2020, we sold an asset. They tell us that the cost price of this asset is 76,000 Rand. So what we are going to do is we are going to minus, okay, the cost price at the beginning of the year minus the cost price of the asset that we have sold. And that means what we have left over is 236,000. The reason why we have to take this out is because we sold this halfway through the year. So we can't make provision for depreciation on the sold asset for the whole year because we didn't have it for the whole year. But the remaining assets, the ones that we haven't sold, for these ones we are going to make provision for depreciation for the entire year because we had them for the whole year. So we take out the sold one so we can calculate the depreciation for it separately. We do the same thing for the accumulated depreciation. We take the accumulated depreciation at the beginning of the year that they gave us minus the accumulated depreciation because they told us at the beginning of the year, this asset that we sold, it had an accumulated depreciation of 34,200. So we take the balance for all the vehicles minus the accumulated depreciation for the vehicle that we sold, and that is going to tell us what is the accumulated depreciation on the vehicles that we still have left, the ones that we didn't sell. Okay, and then we have to calculate now the depreciation for each category. All right, so we're going to calculate the depreciation for the asset that we sold. All right, so the sold vehicles, it's on carrying value. Remember, that's the method that we are using. So this 41,800, that is the carrying value that we're going to use to calculate the depreciation. Depreciation is calculated as 20%, and then your timeline is important. Okay, the year started on the 1st of March, so you're going to count. Okay, there's March, there's April, May, June, July, August. Okay, we sold it on the 31st of August, so we have to count August as well. So there's 6 months that into the year. 6 months into the year is when we sold this asset, so we have to depreciate it then for 6 months, which means that the depreciation on the sold asset is 4,180. Then we have to calculate the depreciation on the assets that remains. Okay, the asset that was there in the beginning of the year that is still there at the end of the year, that is straightforward. Okay, we're going to again take carrying value. So this amount, 166,200 is the carrying value, and we're calculating 20% depreciation. These assets we've had for the whole entire year, so we don't have to count the months, and that was 33,240. But then they also told us that we bought a new vehicle on the 1st of December. We bought a new vehicle. Okay, the cost price of that vehicle is 200,000. We use the cost price for the new vehicle, okay, because obviously we don't have accumulated depreciation for this one. So basically for your new vehicle, your carrying value, your cost price is exactly the same because we haven't made provision for depreciation on this vehicle yet because we bought it. It's brand spanking new now and we haven't depreciated it yet at all. Okay, so then we use the cost price of 200,000. Okay, the percentage is still 20%, and then we bought it on December. Okay, our financial year end is the end of February. So we're going to calculate beginning of December. So we have to calculate depreciation for December and January and February, which is when the financial year is going to end. So we make provision for 3 months of depreciation. And if you do that, you will see the amount is 10,000. And now the easiest thing in the world to calculate the depreciation for the whole year, we're going to put all of this together. Okay, the sold vehicle, the sold one, the old one, and the new one. All right, so the sold vehicle, that was the depreciation for this year. The remaining, the old stuff, that was the depreciation. And then the new one, that was the depreciation, which means the total depreciation for the year is 47,420. If we put that now into our ledger accounts, okay, for vehicles, the balance brought down. This was at the beginning of the year. This was given in the information at the beginning of the year. We were told that on the 1st of December, we purchased another vehicle. We purchased it for cash. That is why the contra account here is bank, okay? And then there was asset disposal. We sold a vehicle. This has to be captured at cost price. Everything in your asset account has to be at cost price. All right, and once we've captured all of that, we can calculate what is the balance that is left over at the end of the year. Okay, so at the start of the next financial year, this would be the balance of our vehicles that we have left over. Okay, as I said, very important. Remember, in your asset account, we're always going to capture your transactions at cost price, not at carrying value. If we look at your accumulated depreciation on the vehicles, the balance at the beginning of the year was given as 104,000. Then we made provision for the sold vehicle, the old vehicles, and the new vehicles. So for the sold vehicle, the depreciation was 4,180. For the old vehicles, the remaining ones, as well as the new one, if we add those two together, it is going to give us 43,240. And then there was asset disposal. Now for this, you need to remember this 34,200 was the accumulated depreciation at the beginning of the financial year. So we still have to add the extra depreciation, the extra 6 months worth of depreciation that we had to make provision for. And that is going to give me this 38,380. All right. And then obviously we just need to balance. All right. So obviously the balancing is easy. So the balance carried down, obviously at the end of the financial year, would be the balance that we bring down at the beginning of the next financial year. But you'll see we've taken out the accumulated depreciation on the disposed asset. We take it out, we debit it to get rid of it. We can't reflect on our statements anymore because we don't have the vehicle anymore. Then this is what your asset disposal account is going to look like. On the debit side, you have the vehicles. Okay, this is the vehicle that you have disposed of. This is going to be the cost price. All right, on the debit side, we have the cost price of the vehicle. Then on the credit side, the accumulated depreciation on the vehicles. Again, this is the sum total of the accumulated depreciation of all the years, including the 6 months of the last year before we sold it. So this again would be the balance at the beginning of the year. Okay, what was the accumulated depreciation at the beginning of the year, plus the extra depreciation that we've made provision for the 6 months of this year before we sold the asset. And then in this case, we sold it on credit. So your contra account here has to be debtors control. This is the amount that we received for it. It was given in the information. We sold it for 47,200. So that is what we have received for it. And then obviously we need to see, did we make a profit? Did we make a loss? In this case now, your credit side is bigger. Okay, so in this case, the missing item 9,580 is on the debit side, which means that we've made a profit on the sale of this asset. Okay, so how will this be reflected now in my note 3? Okay, the carrying value at the beginning of the year. Obviously, we were told that the cost price at the beginning of the year was 312,000. This was information that was given in the question, and the accumulated depreciation was given for us as well. So if we take the 312,000 minus the 104,000, that is going to give me the carrying value at the beginning of the financial year. They tell us, remember, on the 1st of December, we bought a new vehicle for 200,000 Rand. Remember, this is captured at cost. Then the disposals at carrying value. This is very important. Remember now, the carrying value, we have to take the cost price, which was 76,000 Rand, minus the accumulated depreciation that was given to us at the beginning of the year, and then minus the additional depreciation that we've made provision for the 6 months of this financial year before we sold it. So altogether, that is going to give me 37,620. Okay, then we put this year's depreciation. Okay, this amount here, 47,420. Remember, that includes all the depreciation, the total depreciation for the year, the sold vehicles depreciation, the old ones, as well as the new one. That is the total depreciation for the year. Okay. Now, if we want to calculate the cost price here, okay, we are going to start basically with the cost price at the beginning of the year. Okay, so we're starting with this 312,000. we add the additions, so the new stuff that we bought, and we add the stuff, the vehicle that we have, we subtract the value, the cost price of the vehicle that we sold. And that is going to give me this 436,000. Okay, so the 312,000 was the cost price at the beginning of the year. The 200,000 was the additions during the year. And the 76,000, remember, we can't minus the carrying value. We are calculating cost price. Okay, we are looking for cost price, not carrying value. So we have to minus the cost price of the vehicle that we had sold. And that is going to give me this amount. Then we do exactly the same thing for accumulated depreciation. We're going to start with this 104,000. That was the balance at the beginning of the year. Then we have to add the depreciation that we've made provision for during this year. But we have to minus the accumulated depreciation of the vehicle that we sold because we don't have it anymore. All right. So basically that is going to be the 104,000, the balance at the beginning of the year, plus the depreciation that we've made provision for this year, minus the accumulated depreciation of the vehicle that we sold. Not just the depreciation for this year, the accumulated depreciation of the vehicle that we sold. And that is going to give me the accumulated depreciation at the end of the year. And then obviously your cost price minus your accumulated depreciation is going to give me the carrying value. Easy peasy.